David, coming out of the block for you, this Goldman Sachs note really has caught my eye. They are recommending buying the dips in the market. Now, stocks are off their highs. Does buying the dip right now make sense to you?
I think it does. When you look at the Fed potentially cutting interest rates, nobody's talking about them hiking rates. You look at unemployment numbers around 4%, and you look at a situation where the federal government has basically created enough stimulus that they're going to be running a $1.8 to $1.9 trillion deficit over the next several years. I think that's a very good reason to think the stock market will do well over the next few years upcoming.
Ines, welcome back to the opening bid roundtable. We indeed missed you here. So what do you think about this Goldman note? I haven't seen investors really come out here and aggressively buy this dip. It's like they're nibbling around the edges.
They are nibbling around the edges. Thanks. Great to be back here from Spain. I will tell you, look, investors are expecting, the Fed to come in and sort of save the stock market. You saw the rise on Friday. And at this point, if the markets go down too much, then you start to see announcements. You start to see, the Fed getting more dovish. You have President Trump that has eased off of the tariffs on beef, on coffee, the $2,000 stimulus. So yes, the expectation is that you don't want to let this slide go on too much, this volatility go on too much, and you will start to see more dovishness. And therefore, you're seeing stocks rallying because of this. If you look at what happened on Friday also, Saz, you look at even the consumer names that have been getting beaten up. Chipotle was up on Friday. You saw Macy's that was up. Even Dave & Buster's, which has had a terrible year, that was also up on Friday. So there is this expectation that the Fed is going to step in, and you also have the expectation that the government is going to do things to sort of goose the economy, so to speak.
Yeah, I'm not surprised by Dave & Buster's. It's too damn expensive to go there now. Inez, I can't help myself. You're in Spain. What are the prices like there?
I was in Madrid. They were good. I mean, look, you have, it was great to be able to eat out and better than here. They were better than here. Even though the euro is a little stronger than the dollar, it was much better than being here. It was great. A great trip.
Good to hear. Good to hear. Brooke, look, key to this, I think what Goldman is saying is that the consumer doesn't fall off a cliff. And we've gotten some really mixed reads on all things consumer. Gap was good, TJ Maxx was good, Home Depot not so good in terms of earnings, Lowe's was so-so. This week we got Best Buy coming out. What's the read on the consumer here?
Well, Brian, we're going to get a slew more of data and read on how the consumer responded to all these earlier than expected holiday sales. We saw, Prime really come out on top, and then Target, Walmart followed. But right now we're waiting to hear from other companies as well, like Kohl's, Best Buy, Abercrombie & Fitch, as well as Dick's Sporting Goods this week. And National Retail Federation does expect the consumer to go out and spend big this year. They expect this to be the first holiday season where consumers will spend more than $1 trillion. And so there's certainly lots of momentum behind the consumer right now as they really sort of surprise the street with their ability to go out and spend. But as we know, this economy is really being propped up by that high-income consumer. That's a lot of what we heard last week, where that low-income consumer is still under pressure. Even Walmart pointing out that, yes, they saw growth across all income cohorts, but their low-income consumer was also under pressure as well. And also within this Goldman note as well, a weaker than expected labor market has certainly played into that factor in the fall here as well.
David, let me get over to you. How important is it that the AI CapEx narrative stays strong for next year? If investors aren't buying into that narrative next year, why won't this market be at least 10% lower?
I think if that were something that was likely to happen, that would be a very real concern. But we saw the last NVIDIA number. We can see the real demand. We can see consumers moving to using AI. I don't see the possibility that over the long term, technology is not going to be a bigger part of our lives. When you look at that persistent growth in demand and backlogs, I don't really see the scenario, even if there was a bit of an economic downturn, where you wouldn't see persistent and consistent growth for technology products.
David, real quick on this one, before I get to crypto. NVIDIA, of course, we saw that in reversal last week. Good earnings. Stock reversed, broader market got pressured. If Dell comes out, also an AI play, they work very closely with NVIDIA. If they report earnings this week and we see that same type of movement, what's your read?
I don't think Dell is nearly as much of a barometer for the market as NVIDIA was. If NVIDIA came out with weak numbers, it would have been disastrous. But I think the much bigger thing driving the market from here is any Fed statements on where they're going with interest rates. Any movement on the denominator for those rates, if they go ahead with cutting and do things to try to accommodate the market, I think that's what's going to really matter. I think the Fed now is actually more concerned probably not so much what's happening with the stock market or employment, but some of these cracks in private credit.